Have you ever looked at a company like Apple with its trillion-dollar valuation and just wondered, how? How do they get to that number? Or, how do venture capitalists decide if that hot new startup is actually worth pouring money into? Well, it all boils down to one of the most crucial skills in finance, figuring out how to value a company. And today, we're going to pull back the curtain and show you exactly how the pros do it.
So really, how do you put a price tag on an entire business? I mean, it's not like you can just pull a number out of thin air. It's a pretty complex process for sure, but we're going to break down the two main methods that Wall Street professionals use every single day to get to an answer.
And trust me, this isn't just some boring academic exercise. This stuff matters for huge decisions. We're talking about multi-billion-dollar mergers and acquisitions, right? We're talking about companies going public in an IPO. It's even critical for you when you're trying to figure out if a stock you're looking at is a bargain or way overpriced. It is an absolutely essential skill.
Okay, so our first method is really the workhorse of valuation. It's called the discounted cash flow analysis, or DCF for short. I want you to think of it like a financial crystal ball. What we're trying to do here is figure out a company's intrinsic value, what it's fundamentally worth, based on all the cash it's expected to make in the future.
So here's the official textbook definition. A DCF is all about estimating a company's value today by forecasting its future cash flows, and then, and this is the most important part, discounting them back to what they're worth in the present. So why do we do that? Well, it's all built on this one simple but incredibly powerful idea, the time value of money. Think about it. A dollar you have in your hand right now is worth more than a dollar someone promises you a year from now. Why? Because you could invest that dollar today and earn a return on it. The entire DCF method is built on this one principle. The whole process really breaks down into these 4 key steps. First up, you have to forecast the company's future free cash flows, usually for about 5 or 10 years out. Second, you figure out a discount rate. This is often the weighted average cost of capital, or WACC. Basically, it's a number that reflects how risky the company is. A riskier company gets a higher discount rate. Third, since you can't forecast forever, right, you have to estimate something called a terminal value. That's just a single number that represents the value of all cash flows after your forecast period. And finally, you take all those future numbers, discount them back to today's dollars, and add them all up. That's your valuation. But look, a DCF can feel a little theoretical, right? It's jam-packed with assumptions about the future. And that's exactly why we have our second method, multiples. This is valuation's reality check. Think of it less like a crystal ball and more like comparison shopping for a house in a new neighborhood. And this slide just lays out the difference perfectly. A DCF is all about intrinsic value. It looks inward at the company's own potential. Multiples, on the other hand, are about relative value. It looks outward at what the market is actually paying for similar companies today. And the process for this one, it's way more straightforward. First, you just find a peer group, a bunch of similar, comparable companies. Second, you calculate what their average valuation multiple is. A super common one is enterprise value to EBITDA, which is basically the total price of the company divided by its core profit. Then, step 3 is easy. You just apply that average multiple to your own company's profit number.
Okay, let's make this super real with an example. So on this slide, we've got 3 similar companies. We can see that the market, on average, is valuing them at 15 times their core profit, or EBITDA. So if our target company here also has an EBITDA of $25 million, well, we can use that market average as a powerful shortcut. We just multiply that $25 million by 15, and boom, we get a relative valuation of $375 million. It's a fantastic way to check your work from the DCF.
So we have the DCF, our crystal ball, and we have multiples, our reality check. So which one is right? Well, the truth is you need both. Valuation is just as much an art as it is a science, and using both of these methods together gives you a much, much more complete picture. You see, you don't use these methods to find one single perfect number. That's not the goal. Instead, you use them to create a reasonable valuation range. As you can see right here, the DCF might give you one number, and the multiples analysis gives you another. The company's true value is probably somewhere in between those two goalposts. Now, here's something that might actually surprise you. This chart reveals the single biggest assumption baked into a DCF. Remember that terminal value we talked about? The value of the company forever into the future? Well, that one number often makes up over half of the company's total estimated value. In this case, it's a whopping 60%.
And as Professor Hans Smit says, because the terminal value can make up a large portion of a company's total valuation, it is important to perform checks. He's absolutely right. Since it's such a huge piece of the puzzle, you have to double and triple check your assumptions. A tiny little tweak to your long-term growth rate can have a massive impact on your final number.
But what if a company's value isn't just about the cash it's making today? What about its potential? What about its strategy for the future? This is where these standard, spreadsheet-driven valuation techniques can sometimes fall a little short. This leads us to a more advanced concept called the expanded net present value. And the idea is pretty simple. It says that a company's true value isn't just its current business, the value of assets in place that a DCF is great at measuring, but it's also the often hidden value of its future growth options. So what in the world are growth options? Well, they're all the strategic possibilities a company has at its fingertips. Think about a pharmaceutical company's pipeline of R&D projects, or a tech company's ability to expand into a whole new country, or even just the flexibility to buy up a smaller competitor. These things are incredibly valuable, but a standard DCF just might not capture their full worth.
Which really brings us to our final question. What is a company's true value? Well, as we've seen, it's not just one number on a spreadsheet. It's a complex blend of what that company is earning right now, what similar businesses are worth in the market, and maybe most importantly, the strategic value of all the different paths it could take in the future.